Welcome back. NASDAQ hitting a record high today. NVIDIA becoming the first company ever to reach $4 trillion in market cap. Question now, should you continue to lean into that trade or diversify elsewhere? Joined now by Elizabeth Burton, Chief Investment Strategist for Goldman Sachs Asset Management. Welcome back. It's good to see you.
Good to see you.
You're on the diversification train, right?
Yes.
Don't just lean into tech or large cap.
We're always on the diversification train.
Yeah, but I mean, you know where I'm going with this. It's like we've gotten to these record levels,
right,
and we're talking about NVIDIA today for a reason.
Right.
Those are the stocks that got you here, but what's going to get you to the next level?
Okay, I think there's a couple interesting things happening right now. One, the breadth in this recovery has been pretty narrow, which for one means that there's opportunities for more downside ahead, but it also means there's opportunities for things to sort of catch up. And the other thing that we've been saying is this U.S. exceptionalism narrative is sort of overblown. We don't buy into that. One reason for that is when you think about the U.S. and the reinvestment into their businesses. So the U.S. Mag 7 is around 56% on cash flows from operations. If you think about the remaining 493, they're at 36. Outside of the U.S., they're closer to 26. So while we still think there's diversification, we're not saying get out of the U.S. In terms of the diversification story, I remember a year or two ago when I was saying we're suggesting going down and out, going down in cap and outside of the U.S. And I think that's still a large part of the story and is only getting more interesting.
Can down in the cap work in the U.S.?
Yes.
I think that's the biggest question, right?
Yes.
Because it hasn't worked well.
So we think there's a couple reasons why it could work well now. For one, those smaller cap companies, and I'm not necessarily talking the Russell 2000, I'm talking about an active approach to small cap, but those smaller companies tend to be more domestically oriented, so maybe you get some benefit from being isolated more from trade impacts. If we do see a decline in rates, the small caps should take advantage of that opportunity sooner than the larger caps because they have, more floating rate debt. I think another thing that we're saying is, big companies, you want to implement AI, that might take years and a bunch of people getting together in rooms. At a smaller companies, that probably goes a lot faster. And then finally, on an EV to sales ratio, small caps are actually about half the value of large caps there. So there's a pretty big discount. So there's reasons for earnings growth there, and there's reasons for valuation expansion.
Better economy plus rate cuts helps that trade?
It should. A better economy should help a lot of trades, but I think
sure. But I mean, you can't have one without the other in terms of small caps, right?
Yeah. I mean, I think that there's a lot of potential tailwinds there, and adding some exposure in small caps certainly makes sense as long as it's within the broader themes that we continue to be talking about. So I think security is one that we're really
cyber.
All sorts of security. I mean, it's been a while, but I'm old enough to remember the California wildfires. Like, there's food security, water security, defense, cyber, AI. We're now big part of the AI trade is now thinking about how security and data security is really involved in that.
Do you worry at all that the market's just moved on too quickly from the tariff story, that it's made up its mind that it's not going to be as bad as once feared, and it's just going to go until it can't? It's going to go on the assumption that it's not going to be as bad, and if it is, it'll just deal with it when it has to.
Well, I think July 15th and thereafter will be sort of telling when we start getting earnings reports. There wasn't really a whole lot for the market to really react to on the tariff front yet. And even though we've had a couple deals, there's still quite a few more to go. So I think the earnings season will really tell us what we need to think about when we hear from the managements. And look, on the earnings, I believe a colleague of mine was saying this the other day. It seems to be like investors are seeing the tariff trade as more of an idiosyncratic company-specific story, not a beta story for the broader market. So we'll see if that's true.
Yeah. I mean, we may not know for a handful of months. Are you confident with earnings? That earnings are going to deliver?
Right?
I know the expectations have come down so much.
4%. I think that's a pretty low bar to beat. So I think we're pretty optimistic that the market will be able to beat those expectations, but we'll have to see.
What do you think about a group like the financials, for example? Can you go down in? It's been look, J.P. Morgan, Goldman Sachs, your firm been trading at record highs. Can you go down the cap space in the banks, do you think, as part of your small mid-cap area to expect better things from?
Well, look, I'm not a small cap bank expert here, but I would say.
But you can't get the small caps to work without the banks. It's the largest part of the small cap world.
I agree with you. I think there's look, the bank trade is interesting, by the way, not just in the U.S. It's interesting in other places too, and I think there's certainly tailwinds behind that. I think there's a lot of other places to look, by the way, that might have been overlooked by the market where people need to start taking a broader look. One thing I'd like to start investors thinking about pivoting to, by the way, is taking a quantitative approach to looking at these markets. It's really hard to synthesize all these data, particularly in small caps, which you know are undercovered. On a global and a local basis, thinking about a quantitative lens for those investments can help you get some scale.
Alternatives. Private credit is on your list. And frankly, we haven't talked that much about private credit lately. I feel like it's all we talked about, and then we didn't, and here we are still getting suggestions. What about it?
Private credit is an all-weather strategy, and I think that's something I've really been trying to communicate to my clients. I think a lot of folks thought in a rising rate environment, they understood the story for why private credit worked. Well, in a declining rate environment, that's better for the borrowers and repayment, right? What I think is happening on the client side for us is they're migrating from the 1.0, the direct lending, to more sort of niche sectors in private credit. And I would anticipate we'd start to see a broadening out of that, more interest in real estate debt potentially. For example, we're seeing a lot of interest in asset-backed. So I think that should continue.
All right. Good to have you back.
Thanks for having me.
We'll see you again soon. Elizabeth Burton from Goldman Sachs up next.